I think that the physical market is starting to exert pressure on the paper derivatives purveyors and the banks that are short derivatives. Hello, land of Arcadia economics. My name's Dave Kranzler from Investment Research Dynamics, and welcome to another bi-weekly episode of my podcast that I do sometimes with Chris, sometimes by myself. And I'm waiting patiently for Fortuna Silver to release their second quarter numbers, so I thought I would bang out this recording. I'm terming today affectionately Your Dumb Day. Now, that's not to say that Arcadia audience is dumb, but for anyone who believes the CPI number that was released today, you're dumb. CPI is one of the most manipulated, hedonically adjusted economic reports produced by the government, that and the GDP and the employment report. And the main driver of what the government is claiming was no increase in inflation from June to July was a big drop in the price of gasoline. Well, guess what? Just over the last 4 days, the price of gasoline is up 10% in terms of gasoline futures. And we know that a big driver of the gasoline prices, or driving the price lower, was the Biden government unloading petroleum from the Strategic Petroleum Reserve for political purposes. Well, that's not going to last, and it's going to snap back and backfire sometime in the next several months, and we'll see much higher gasoline prices at the pump. So enjoy the prices now that you're paying. For those of you who were freaked out by the price of gold smack that occurred today after the CPI was released. I mean, gold did spike up along with equity futures, and then it did another cliff dive right back down to where it came from. Keep in mind, this is all in the paper market. The truth is, what you're seeing on the COMEX is not in any way reflective of what's going on in the physical market. And the physical market is primarily in the Eastern Hemisphere. And these consist of large entities that are buying physical gold, and they are removing physical gold from the exchanges that sell it to them and taking it into their own custody and their own safekeeping. And we all know that the countries that are the large buyers is India, Russia, and China, and along with a handful of other Eurasian central banks that have been accumulating gold, as well as Middle Eastern central banks. So how do I know that what we're seeing in the paper markets of London and New York is not representative of what's going on in the physical market? Well, let's just look at least according to the World Gold Council, India's importation numbers for June. In June, India imported 107 tons of gold. This was the highest in 5 months, and it was more than double the June 2021 figure. So while China had been relatively dormant for several months, all of a sudden, starting in June, it was started importing a lot of gold. And this isn't just a function of Shanghai being reopened from the lockdown that it had. In July, one point about the import numbers. The World Gold Council only picks up on the gold that goes into China through Hong Kong. And I'll be discussing all of this in my latest mining stock journal that comes out tomorrow. I'll be discussing it in detail and why it's incredibly significant. But China also imports gold through Beijing and Shanghai, and intentionally those numbers do not get reported. So the only numbers that the world sees in terms of China's gold importation is the gold that's officially reported that goes through Hong Kong. Now, even more interesting, in July, there were 161 tons of gold withdrawn from the Shanghai Gold Exchange. And again, I'm going to explain why this is important, but when the Shanghai Gold Exchange reports a withdrawal, it's completely different than when we see gold being withdrawn from the registered account in COMEX vaults and moved into the eligible account, or vice versa. It's a completely different dynamic, and I'll explain that in a second. But at any rate, the 161 tons that were withdrawn from the Shanghai Gold Exchange was the highest for a July since 2015. And 2015 was a record year of gold importation for China. And I also want you to consider that 2015, the end of 2015, was the end of the 4.5-year bear market that we had in the precious metal sector. And I don't think it's coincidental that it coincided with China hoovering up gold that year. I think that's an example of the physical market forcing the issue in the paper market and driving the price higher. So at any rate, what it means when gold is withdrawn from the Shanghai Gold Exchange is that physical gold is removed from the exchange by the entities that are taking delivery of that. And by contrast, and let me just share a graphic with you if I can work this properly. By contrast, when we talk about withdrawals on the COMEX, you can see here, as of June 24th, this was on June 24th. I'm using these 2 days to illustrate my point. There was 741,000 ounces of gold withdrawn from the registered account and moved into the eligible account. Now, that registered gold, as everyone knows, is the gold or silver, gold or silver, is the metal that's available, that's been made available and passes COMEX standards and is available for entities that stand for delivery on the COMEX. Well, not that many people entities stand for delivery on the COMEX, so to me, it's not really that important. But my point here is that between June 24th and August 9th, the total amount of silver in the COMEX vault system, if this number is to be believed, and there's reasons why it isn't necessarily to be believed, is unchanged. So when we hear people talking about, all this silver that's being removed from the COMEX, it's not being removed. It's an accounting entry that shifts those silver ounces from the registered account to the eligible account. And, over this space of about a month and a half, the total amount of silver that the COMEX says is in their vaults is basically unchanged. And that contrasts from the Shanghai Gold Exchange, which is when there are withdrawals, that silver is physically removed and taken out of the exchange. That is a true physical market. The COMEX, the LBMA, to some extent, basically a paper derivatives market. It's largely unallocated metal that it can be delivered and redelivered and hypothecated several times over. So, but the COMEX aside, I guess my ultimate point here is that I do believe that gold and silver and the precious metal sector is forming a very investable bottom. We're going to see days where the sector gets pushed lower. There's a lot of manipulation, and that's not going to go away. But I think that the physical market is starting to exert pressure on the paper derivatives purveyors and the banks that are short derivatives. I mean, as has been discussed and most recently detailed by Rafi in his last podcast for Arcadia, there is physical gold and silver that is being removed from the global vault system, and it's going to big physical buyers somewhere. And part of the physical buying that's occurring is believe it or not, the retail buyers from the mints in the U.S. mint. And that explains why premiums are so high, even though they've come down a little bit recently. I believe they're going to start to go back up again. And it also explains why the banks have been aggressively reducing their short exposure, at least the short exposure that we can quantify on the COMEX, by going net long silver and aggressively reducing their gold shorts. So the net of all of this is that I think, and again, I don't want to put a time frame on it, but I do believe that we are going to see much higher prices for gold and silver, irrespective of whether or not the Fed pivots or continues to hike interest rates. And I think if you have investable cash that you're looking for a place to seek shelter from the madness that's going out there, from the madness created by all of the "you're dumb" people, then I think it's now's a good time to start accumulating physical gold and silver. Buy it from your favorite coin dealer, take delivery of it, safekeep it yourself. And now is also a great time to start either doubling down in mining stocks or starting positions in some of your favorite ideas. So if you're looking for some ideas, my next issue of the Mining Stock Journal is going to be released tomorrow afternoon. And I'll have several ideas in there that I think have been unreasonably beaten down in this latest sell-off. And I think most of them are going to outperform the sector, assuming that we do have a sustainable bull move. I think they'll outperform the sector. And a couple of them are junior exploration plays that I think are potential 5 to 10 baggers. So at any rate, you can find more information about my Mining Stock Journal or my CPI journal at investmentresearchdynamics.com. And I look forward to doing the next podcast in a couple weeks.